I've done a lot of research over the years on something that's called decision fatigue and what happens to the human brain when it has to make too many decisions. Most decisions are wasted or used up on logistics. So by the time the brain gets to having to make a strategic decision, it is kind of in a reckless mode. And when the brain acts reckless, it does one of two things. It does nothing because it doesn't know what to do, so it does nothing. And the other thing, which is equally reckless, is it does some sort of major action just to do something. But both of them can be very reckless to your money. And for years, the Fed has been making many decisions about what interest rates should be and how much money they should print. And it's been basically it's been an experiment. And it's not just the Fed doing it now, and they've backed off on the quantitative easing, but they keep rates very low. Europe is in on printing money and lowering rates. So is Japan, and China is in on it too. So you have four major central banks in the world that are having to make decision after decision after decision, and eventually they will hit decision fatigue to themselves, just like every individual investor hits decision fatigue. And this is one of the reasons why owning many, many, many different positions is very bad for someone's investments. Hey everybody, this is RC Peck, and this is my weekend podcast. And the theme for this weekend's podcast is, did the Fed just lose it? Now, I don't want this to be one of those hypey theme subject lines like the Fed just lost control and all's going to end. But at a certain point, the Fed is not going to be able to control interest rates. And maybe they've never controlled interest rates. In fact, they only control the very short end of the yield curve, and they've never controlled long-term rates. Well, one thing I just found interesting of all the stuff that's going on over the last week, probably the most interesting thing to me is the 30-year bond, showing here with the ticker symbol TLT, is breaking down. In fact, it's broken down pretty significantly since peaking in about February of this year. Now, what you're looking at here on the screen is a price chart that goes back to the middle of 2002. So a pretty good amount of data. And that blue horizontal line is simply showing what I call the support resistance line. TLT, or the long bond, hit a major high in 2012 and then really backed off on it, dropped about 20%, and then moved way above that. And you can see it here, broke down about 20%, and then move above that. Well, what is going on right now in this price action is really interesting. So what I want to do is zoom in on this and just talk about what I'm seeing. So this is just a zoomed on area where the support is becoming the resistance. This line used to support the price, having a price bounce off it and move up, and now the price is broken through it. So this is very early. One breakthrough does not make a change of trend after 33 years. So I'm not simply trying to call the top or doing anything like that. That would be predicting. I'm simply noticing how the move down in interest rates has been, the move down in price has been pretty severe over a short period of time. And when the price falls with bonds, the yield goes up. So the yield has gone up, and that puts pressure on REITs. Those are real estate investment trusts. That puts downward pressure on any type of bond, because when the price falls, the yield goes higher. And if you own bonds, then your bonds are worth less. So anyone who owns bonds, and there's a significant amount of people who do, they're getting hurt with this. Now, what's also interesting during this move up in interest rates, the long term, the stock market, specifically the U.S. stock market, it's really stayed sideways. It's just been kind of going sideways, and my take on it is it's really digesting this information before it makes its next major move up or down. But with the move up in yields, that should put some competition on stocks because the yields are going higher, and the higher the yields are, the more competition it has for stocks, which doesn't necessarily mean stocks will fall. It just gives more of a competition to it. So as of right now, and this will be interesting to watch, and I am watching it, yields are going higher right now on the long bond or on the long end of the yield curve, and also moving in on the 30-year, the 20-year, the 10-year. The the interest rates or the yield is moving higher. So it'll be interesting to watch what happens. Nothing to do right now, no major changes, but the longer the price of TLT or the long bond price stays below this kind of support resistance line, the more that, let me go back to this other chart, the more that this move above could be called what's called a false breakout. And the longer it stays below, the more likely the direction in trend will change. Now the takeaway right now, I mean, there's many implications. One of them, which I don't have on here, but one of them is stocks usually don't do that badly when interest rates start rising. So an increase in interest rates doesn't necessarily mean bad things for the stock market, though it will put pressure on it to perform better. And if it doesn't, then that will put pressure on the price moving down. So we may see interest rates going higher even before the Fed themselves moves up their federal funds rate. So the takeaway, interest rates could start rising. I mean, they're rising right now, but let's see if this is more than just a correction rather than a change in trend. But the bigger thing is really, and that's it's potentially bad for gold, and it is bad for bonds, which is concerning because tens of millions of people, older people, are in bonds, and when those prices start falling, they will start looking for other things. They will start reaching even more for other types of ways to make up for those losses, including high yield bonds. And it will most likely be bad for gold over the short run because higher interest rates puts a kind of a pressure on gold because gold doesn't actually pay an interest rate. Hey guys, this is just one really small step and check-in to help you secure your future and your portfolio. Until next time, this is RC Peck.